The content provided on this channel is for informational and entertainment purposes only. I am not a financial advisor, and nothing in these videos should be considered financial, legal, tax, or investment advice. All opinions expressed are my own and based on personal experience and research. Investing and trading involve risks, and past performance is not indicative of future results. Always conduct your own due diligence and consult with a qualified financial professional before making any financial decisions. This channel may feature affiliate links or sponsored content, which helps support the channel. However, I only share products and services I believe in. By watching and interacting with this content, you acknowledge and agree that the channel owner is not responsible for any financial losses or decisions made based on the information presented. Stay informed, do your own research, and invest responsibly. Market crashes are pivotal events that can dramatically alter the financial landscape, impacting investor wealth and confidence. Understanding these crashes is crucial for anyone involved in investing, as they can lead to significant losses and affect long-term financial goals. Recognizing the signs that precede a market downturn can empower investors to make informed decisions and potentially safeguard their assets. In this video, we will outline 4 unmistakable warning signs that often signal an impending market crash. First, we will discuss the role of excessive market speculation, where irrational exuberance can inflate asset prices beyond their intrinsic value. Next, we will examine the impact of rising interest rates, which can increase borrowing costs and slow economic growth. The third sign involves declining corporate earnings, as a drop in profitability can lead to reduced investor confidence and stock sell-offs. Finally, we will highlight the importance of geopolitical tensions, which can create uncertainty and volatility in the markets. By being aware of these indicators, investors can better prepare for potential downturns, allowing them to protect their investments and navigate through turbulent times. Ultimately, staying informed and vigilant can make a significant difference in maintaining financial stability during market fluctuations. Throughout history, several major market crashes have left indelible marks on the financial landscape, each with profound consequences for investor wealth. The 1929 stock market crash is perhaps the most notorious, marking the onset of the Great Depression. This catastrophic event wiped out billions in wealth, leading to widespread unemployment and economic despair. Investors who had once been confident in the market found themselves facing ruin as stock prices plummeted and banks failed. Fast forward to 2008, when the financial crisis struck, resulting in an estimated $8 trillion loss in value across global markets. Triggered by the collapse of the housing bubble and risky financial practices, this crisis not only devastated individual portfolios, but also led to a severe recession, prompting government bailouts and regulatory reforms. A common belief that contributed to both crashes was the notion that markets could only go up, fostering a sense of invincibility among investors. This overconfidence often leads to reckless investment behaviors, ignoring fundamental economic indicators. The lessons learned from these historical events emphasize the importance of maintaining a cautious and informed approach to investing. By understanding the factors that precipitate market crashes, investors can better prepare themselves and avoid repeating the mistakes of the past, ultimately safeguarding their financial futures. Market crashes are often the result of a confluence of factors that create an unstable financial environment. One significant contributor is overvaluation, where asset prices exceed their intrinsic value, often driven by speculative trading. When investors realize that prices are unsustainable, a rapid sell-off can occur, leading to a sharp decline in market value. Excessive leverage also plays a critical role. When investors borrow heavily to amplify their positions, even a slight downturn can trigger margin calls, forcing them to liquidate assets and further driving down prices. This cycle can create a domino effect, exacerbating the downturn. Investor psychology is another crucial factor, particularly the herd mentality, where individuals follow the actions of others rather than making independent decisions. This behavior can lead to panic selling during market downturns, as fear spreads and investors rush to exit their positions. Historical examples illustrate these dynamics well. The dot-com bubble of the late 1990s saw rampant overvaluation of tech stocks, leading to a crash in 2000 when reality set in. Similarly, during the 2008 financial crisis, excessive leverage in the housing market contributed to widespread defaults and a market collapse. Understanding these factors is essential for investors, as it highlights the importance of maintaining a rational approach and being aware of market conditions to mitigate risks. Overvaluation stands out as a critical warning sign of impending market crashes, and one of the most effective tools for assessing this is the Buffett indicator. Named after renowned investor Warren Buffett, this indicator compares the total market capitalization of publicly traded companies to the country's gross domestic product, GDP. When the market cap significantly exceeds GDP, it signals that stocks may be overvalued, suggesting a potential disconnect between market prices and economic fundamentals. This discrepancy can indicate danger, as it often precedes market corrections when investors reassess the true value of their investments. For instance, during the dot-com bubble, the Buffett indicator reached alarming levels, foreshadowing the subsequent crash when reality set in. It's essential for investors to remain vigilant and aware of current market valuations, as understanding these metrics can provide valuable insights into market health. By researching and analyzing the Buffett indicator and other valuation metrics, viewers can better gauge whether the market is in a bubble or if it reflects sustainable growth. This proactive approach not only helps in identifying potential risks, but also empowers investors to make informed decisions, ultimately protecting their wealth. Staying informed about market valuations is crucial for navigating the complexities of investing and avoiding the pitfalls of overvaluation. Excessive speculation is a critical precursor to market crashes, characterized by investors engaging in high-risk behaviors driven by the hope of quick profits rather than sound fundamentals. This speculative mindset can lead to inflated asset prices, creating an unsustainable market environment. For investors, the implications of excessive speculation can be dire, as it often results in significant financial losses when the market corrects itself. One common example of risky investment behavior is borrowing to invest or using leverage. While this strategy can amplify gains during a rising market, it also magnifies losses when prices decline, potentially leading to margin calls and forced liquidations. Another risky behavior is chasing trends without fully understanding the underlying risks. Investors may flock to popular stocks or sectors, driven by hype rather than thorough analysis, which can create bubbles that eventually burst. Historical examples, such as the housing bubble leading up to the 2008 financial crisis, illustrate how excessive speculation can distort market realities. Many investors bought properties with little regard for their true value, believing prices would continue to rise indefinitely. When the bubble burst, it resulted in widespread financial devastation. Recognizing the dangers of excessive speculation is essential for investors, as it underscores the importance of conducting thorough research and maintaining a disciplined approach to investing, rather than succumbing to the allure of quick gains. Market euphoria often serves as a critical signal of potential crashes, characterized by an overwhelming sense of optimism among investors. This phenomenon is frequently fueled by the "this time is different" mentality, where investors believe that current market conditions are unique and that past downturns will not repeat. This mindset can lead to reckless investment decisions, as individuals overlook historical patterns and the inherent risks associated with overvalued assets. Media hype plays a significant role in amplifying this euphoria, as sensational headlines and optimistic forecasts can create a false sense of security. When the media glorifies rising stock prices and booming sectors, it can encourage more investors to jump on the bandwagon, further inflating asset prices. However, this exuberance often blinds investors to the underlying economic fundamentals, setting the stage for a sharp correction when reality sets in. Historical examples, such as the dot-com bubble, illustrate how media-driven enthusiasm can lead to unsustainable market conditions. During such periods, it is crucial for investors to remain cautious and grounded. By maintaining a critical perspective and conducting thorough research, individuals can better navigate the risks associated with market euphoria. Encouraging viewers to stay vigilant during times of exuberance can help them avoid the pitfalls of overconfidence and protect their investments from the inevitable market corrections that follow. Analyzing volatility patterns is essential for identifying indicators of market instability, as increasing market swings often signal impending crashes. When the market experiences heightened volatility, characterized by sharp price fluctuations, it reflects uncertainty and fear among investors. These swings can indicate that market participants are reacting to negative news or economic data, suggesting that confidence is waning. As volatility rises, it becomes crucial for investors to pay attention to these patterns, as they can foreshadow significant downturns. Another important factor to consider is trading volume spikes, which often accompany periods of increased volatility. A sudden surge in trading volume can indicate that investors are either rushing to sell their positions or are engaging in panic buying, both of which can exacerbate market instability. High trading volumes during volatile periods can signal a lack of conviction in the market, further heightening the risk of a crash. For investors, monitoring market volatility should be an integral part of their investment strategy. By keeping an eye on volatility patterns and trading volumes, individuals can better assess market conditions and make informed decisions about their portfolios. Encouraging viewers to incorporate volatility analysis into their investment approach can help them navigate turbulent markets more effectively, allowing them to protect their assets and capitalize on opportunities when they arise. Psychological factors play a significant role in contributing to investor losses during market crashes, with emotions often driving decisions rather than rational analysis. One prevalent issue is the fear of missing out, FOMO, which compels investors to jump into rising markets without fully understanding the risks involved. This urgency to capitalize on perceived opportunities can lead to hasty investments, often resulting in significant losses when the market corrects itself. Additionally, the herd mentality poses a considerable danger, as individuals tend to follow the crowd rather than making independent, informed decisions. When investors see others buying into a trend, they may feel pressured to do the same, ignoring their own research and analysis. This collective behavior can inflate asset prices and create bubbles that eventually burst, leaving many investors in financial distress. To mitigate these psychological pitfalls, it is crucial for viewers to maintain a rational approach in their investment strategies. Encouraging a disciplined mindset that prioritizes thorough research and critical thinking can help investors resist the urge to follow the crowd or succumb to FOMO. By focusing on long-term goals and adhering to a well-defined investment plan, individuals can navigate market fluctuations more effectively and protect themselves from the emotional turmoil that often accompanies market downturns. Ultimately, cultivating a rational investment strategy is key to achieving financial success and resilience in the face of market challenges. Protecting investments during market downturns is crucial for maintaining financial stability, and one of the most effective strategies is diversification. By spreading investments across various asset classes, such as stocks, bonds, and real estate, investors can reduce risk and minimize the impact of a downturn in any single sector. This approach helps to create a more resilient portfolio that can weather market fluctuations. Another valuable strategy is the all-weather portfolio, designed to perform well in various economic conditions, including inflation, deflation, and recession. This strategy typically includes a mix of equities, bonds, commodities, and cash, allowing investors to benefit from different market environments while mitigating risks. The all-weather portfolio's balanced approach can provide a sense of security during turbulent times, as it aims to achieve steady returns regardless of market conditions. Additionally, adopting systematic investing practices, such as dollar-cost averaging, can further protect investments. By consistently investing a fixed amount over time, investors can reduce the impact of market volatility and avoid the pitfalls of trying to time the market. Encouraging viewers to implement these strategies can empower them to navigate downturns with confidence. By focusing on diversification, considering an all-weather portfolio, and committing to systematic investing, individuals can better safeguard their investments and enhance their long-term financial resilience. In summary, we've explored several critical aspects of market crashes, focusing on 4 key warning signs that every investor should recognize. First, we discussed overvaluation, emphasizing the importance of monitoring metrics like the Buffett indicator to assess market health. Next, we highlighted excessive speculation, where risky behaviors can inflate asset prices and lead to significant losses. We also examined market euphoria, characterized by the "this time is different" mentality, which can blind investors to underlying risks. Lastly, we analyzed volatility patterns, noting how increasing market swings and trading volume spikes can signal impending instability. Understanding these warning signs is vital for protecting your investments and making informed decisions. To further safeguard your financial future, we encourage you to take action by diversifying your investment portfolio. By spreading your assets across various sectors, you can mitigate risks and enhance your resilience during market downturns. If you found this discussion valuable, we invite you to engage with us. Please subscribe to our channel for more financial insights, like this video to show your support, and share it with friends and family who may benefit from this information. Your engagement helps us create more content that empowers investors like you to navigate the complexities of the financial world with confidence. Thank you for watching, and we look forward to seeing you in our next video.